Investing in ETFs is one of the easiest and cheapest ways to invest in the stock market, while giving the average person exposure to some of the top companies worldwide and providing a great return on investment. So in today's video, I'm going to take you through a comprehensive guide with 7 key aspects to give you a better understanding of what an exchange traded fund is, and a step-by-step guide on how to invest in an ETF. So what is an exchange traded fund? An exchange traded fund, or ETF, is a type of investment fund and a financial instrument that is traded on the stock exchange, much like individual stocks. Here are the 7 key aspects to an ETF. Number 1, basket of assets. An ETF pulls money from many investors to create a fund that holds a diversified portfolio of assets. These assets can include stocks, bonds, or other financial instruments. 2, passive investment. Many ETFs aim to replicate the performance of a specific index, like the S&P 500. These are known as passive or index tracking ETFs. The goal is not to outperform the market, but to mirror the index's returns. 3, traded on exchanges. ETFs are bought and sold on stock exchanges throughout the trading day, just like individual stocks. This provides liquidity, allowing investors to enter or exit positions at market prices during trading hours. 4, market price and net asset value. The market price of an ETF is determined by supply and demand on the stock exchange. It can sometimes deviate slightly from the net asset value, which represents the total value of the fund's assets divided by the number of outstanding shares. 5, diversification. Investing in an ETF provides instant diversification since it holds a basket of assets. This helps spread risk across different securities and can be appealing to investors seeking a broad range of exposure to a market or sector. 6, low costs. ETFs often have lower expense ratios compared to traditional mutual funds. This is because many ETFs passively track an index, requiring less active management. 7, variety of ETFs. There are various types of ETFs, including equity ETFs, bond ETFs, commodity ETFs like mining and energy, and sector-specific ETFs like climate and technology. Investors can choose ETFs that align with their investment goals and risk tolerance. Overall, ETFs offer flexibility, diversification, and cost efficiency, making them a popular choice for both individuals and institutional investors. So now you have an understanding of what an ETF is. Let's look at how to invest in an ETF. And I've broken this down into a step-by-step guide. Step 1, brokerage account. To start off, we need to first open a brokerage account with a financial institution or online broker. The reason why we need to open a brokerage account is because we need a special account that will allow us to buy and sell investments. By having this brokerage account, we will be able to transfer money from our everyday bank account into the brokerage account. Then we can use that money to buy the ETF of our choice. To open a brokerage account, you generally need to provide personal information, financial details, and complete the application process on the chosen platform's website. This may involve identity verification, submitting documents, and agreeing to terms and conditions. Always ensure that you are using a reputable and regulated brokerage platform. Some brokerage platforms include CommSec, CMC Markets, Self-Wealth, Raise, Sharesies, and Perla. So if you are unsure what one to go with, please see a professional or do your own research. Step 2, research ETFs. Okay, you now know how to open a brokerage account. It's now important to do your research and explore different ETFs available in Australia or the country you live in. For Australians, you can find information on ETFs through the ASX, the Australian Securities Exchange website, or the website of ETF providers. This will give you a good understanding of what companies or businesses are in the ETF you are researching and whether they align with your investment plan. Step 3, choose an ETF. Now we are on to choosing an ETF. And this is no simple pick and choose whatever looks fancy. You got to really understand what you are investing in and all the factors that go into your choice. When choosing an ETF, investors should consider several factors to ensure that the ETF aligns with their investment goals and preferences. So get a pen and paper out because here are some key points to consider when choosing an ETF. 1 is underlying index or strategy. Understand the index or strategy the ETF aims to replicate. Different ETFs track various benchmarks such as broad market indices like the S&P 500, sector-specific indices, or custom strategies. 2 is investment goals. Define your investment objectives, whether it's long-term growth, income generation, or capital preservation. Choose an ETF that suits your specific goals. Number 3 is asset class. Determine the asset class you want exposure to. ETFs cover a wide range of asset classes, including stocks, bonds, commodities, climate, tech, and real estate. Choose an ETF that aligns with your desired asset allocation. Number 4 is geographic focus. Consider the geographic focus of the ETF. Some ETFs track global indices, while others may focus on specific regions or countries. Your choice may depend on your views on international markets. Number 5 is expense ratio. Evaluate the ETF's expense ratio, which represents the percentage of the fund's assets used to cover operating expenses. Lower expense ratios are generally favorable, especially for long-term investors. Number 6 is liquidity. Check the liquidity of the ETF. Higher liquidity usually means tighter bid-ask spreads, reducing the cost of buying or selling shares. More liquid ETFs are often associated with popular market indices. Number 7 is historical performance. Review the historical performance of the ETF. Keeping in mind that past performance is not indicative of future results. Analyze how closely the ETF has tracked its benchmark and understand any historical deviations. Number 8 is dividends and distributions. If income is a consideration, check the ETF's dividend history and distribution policies. Some ETFs distribute dividends regularly, while others may reinvest them. Number 9 is provider reputation. Consider the reputation of the ETF provider. Established providers with a track record of managing successful funds may provide added confidence in the ETF's management. So there's a lot there for you to consider before buying an ETF. But don't be discouraged. This will just give you a better understanding of what investments you are putting your money into. Okay, now step 4, and this is fairly simple and straightforward. Once you have your brokerage account set up, and that's funding your account by depositing money into your brokerage account to have funds available for purchasing the ETF shares of your choice. And this is simply transferring money from your everyday bank account into your brokerage account. Once your account is funded, you then switch to your brokerage account and use the broker's online platform to place an order to buy the chosen ETF. Specify the number of shares you want to purchase and submit the order. Keep an eye on your investment over time. ETF prices fluctuate based on market conditions, so it's essential to stay informed about your chosen ETF and the overall market. And remember, investing this way is more about delayed gratification. We are not trying to pull money in and out of the stock market. Investing is about long-term financial returns. So be patient and stick with it. And as always, remember that investing involves risk, and it's advisable to do thorough research or consult with a financial advisor before making investment decisions. Well, I hope this video has helped you understand what an ETF is and how to invest in an ETF. If you found some value in this video, please share it with someone who might get some insight into this topic too. Thanks for watching, and I'll see you on the next one. Peace.